Imagine checking your funded account balance only to have the screen go dark. You refresh, but the site is stuck on an under-maintenance notice. For 90% of the firms operating today, this scenario is the likely outcome of the next 24 months. The service provider loophole that allowed these companies to thrive is being systematically dismantled. Regulators in the US and EU have begun harmonizing rules to target simulated trading, viewing it as a way to bypass consumer protection laws and leverage caps. This means that your ability to read the charts is only half the battle. If the firm holding your capital isn't built to survive a total regulatory overhaul, your account is a liability, not an asset. For years, prop firms avoided the prying eyes of financial regulators by claiming they weren't brokers. They argued they were just selling educational software and trading challenges on demo accounts. Here, money bypasses the real market. A $500 challenge fee from one trader directly funds another's $5,000 payout. It's a house of cards. When signups slow or volatility spikes, the firm lacks reserves for payouts, leading to immediate default. The NFA and ESMA have identified this pattern. They are now reclassifying these challenges as a form of gamified financial gambling, which requires the same level of oversight as a traditional brokerage. Firms relying on the software company defense will be forced to either obtain expensive brokerage licenses or shut down, leaving their traders with nothing. Intrigued? We are already seeing the first major pivot. FTMO, the largest firm in the industry, recently acquired a majority stake in OANDA, a Tier 1 regulated broker. This wasn't just a recession move, it was a survival tactic. By owning a regulated entity, FTMO is moving their business from the legal shadows into a transparent institutional framework. This integration effectively turns the demo account into a sub-account within a regulated brokerage. It forces the firm to be accountable for every dollar, ending the era of unregulated virtual payouts. For any firm to exist past 2026, they will likely need to follow this path, either partner with an established broker or face being geo-blocked out of major markets like the US and Germany. There is a catch to this transition. Regulated brokers are legally forbidden from offering 1-to-100 leverage to retail traders in most jurisdictions. Watch what happens to the capital requirements. As firms move under regulatory umbrellas, that 1-to-100 leverage you're used to is forced to compress down to a standard 1-to-30. If your strategy relies on hyper-leveraged scalping, your current model is mathematically incompatible. You'll need much larger stop losses and smaller position sizes to stay within the new rules. Any trader who doesn't start backtesting for a lower leverage environment now will find their strategy broken the moment their firm migrates to a regulated server. While you lose the high leverage, you gain something far more valuable: execution honesty. Most unregulated firms currently run a B-book simulation. Since your trades aren't real, they can manipulate virtual spreads and slippage to ensure you fail the challenge before you ever reach a payout. In the new model, your trades are matched against real market depth. Even if the account is simulated, the data is pulled directly from an institutional liquidity provider. This eliminates the stop-loss hunting that happens on shady internal servers. You are finally trading on a level playing field. Transparent execution ensures that if you are a profitable trader, the firm actually wants you to succeed because your performance is backed by real capital reserves rather than new challenge fees. The cost of maintaining these licenses and legal teams will be too high for most small players. The white label firms that pop up overnight will go extinct. We are moving toward a landscape dominated by a few consolidated, highly regulated financial titans in the industry. This shifts your role as a trader. You aren't just a customer playing a game anymore. You are becoming a remote contractor for a major financial institution. This professionalization is actually good news. It means the payouts you earn are secure and backed by institutional liquidity, providing a legitimate career path for the first time in this industry's history. You need to audit your current firm today. Ask these 3 questions. Is their capital held with a regulated broker? Are they physically located in a Tier 1 jurisdiction? And is their payout history consistent even when market volatility is low? To make this easier, download the FXNX Prop Firm Compliance Audit. It's designed to help you spot the warning signs of a failing firm before they freeze your funds. At the same time, you must begin adjusting your risk management for a strict 1 to 30 leverage environment. Using tools like the FXNX Risk Manager to master these lower leverage conditions is the difference between being a victim of the 2026 crackdown and thriving in the new